Welcome to LuxVoyagEchoes, where we bring you inspiring journeys and expert insights. I'm your host Madhvvi, and today we have a very special guest, Mr. Akhil Chaturvedi, Executive Director at Motilal Oswal AMC. Welcome to the show. Let's start with the basics. What exactly are mutual funds and how do they work?
So mutual funds are, in very simple sense, they are a pooled vehicle with underlying bunch of securities in various asset classes like equities, debt or hybrid funds, where investors can invest with as less as, in today's time you can also come with 100 rupees minimum investment through a SIP. So by putting very small amounts, you can actually buy into a particular mutual fund under a particular asset class and participate into asset classes or investments which a layman may not have proper understanding. So for example, you can have a 100 rupee, 500 rupee or a 5,000 rupee investment into a equity mutual fund, and through that small amount of money you can actually end up buying a bunch of stocks within that portfolio, right? So with small money you can actually participate in the growth of India or India growth story, and participate in the growth of the businesses which are part of the underlying security. So mutual funds are, I think, most convenient, the most efficient and very tax efficient way of participating into a variety of products, a variety of asset classes, and eventually over a period of time they help investors meet their goals successfully.
That's interesting. Mutual funds are indeed popular among retail investors. What do you think that it is?
It's very simple, right? Products are very simple. One can see the portfolios, one can see the track record of the funds, one can see the track record of the fund managers. Most mutual funds have completed 10 years, 20 years, 30 years, even 40 years in existence. So there is a very long track record to evaluate how the funds have done in the past, and therefore how the funds could actually do into the future. So it's very simple, it's very convenient. Like I said, 90% plus of transactions now happen technologically. So you may be in a urban city like a Mumbai, or you could be in a rural town anywhere in India, anywhere in the world. You can just simply transact or buy into mutual funds, sell into mutual funds at a click of a button, right? So these are some of the things which are I think the positives for the mutual fund industry.
Now let's talk about the benefits. How do mutual funds contribute to financial freedom for individuals?
So like I said in my previous response, one can actually invest into mutual funds, whether they are equity mutual funds, debt mutual funds, hybrid mutual funds with a combination of equities and debt. And now you have products which also have exposure to commodities like gold and silver, right? So you can participate into any asset class either through a lump sum contribution or coming systematically through a SIP or doing a systematic transfer plan. So whichever way you want to enter, you can enter very conveniently. And as you hold on to these investments for a long period of time, you benefit from the power of compounding. You look at a lot of funds which have, let's say, completed 20 years and 30 years, their NAVs have grown from 10 rupees to now 3,000 and 4,000. So that's the kind of wealth creation which mutual funds have done for investors over long term. But this is it's a long-term way of creating wealth. Mutual funds don't tend to speculate. So you need to come with a very long-term horizon, and only then can the compounding come into effect and help that small contributions you have made over a period of time, resulting into large pools of wealth.
What about the types of mutual funds available? Could you shed some light on their benefits?
So in very simple terms, there are equity mutual funds, right? So these mutual funds, the objective is basically to invest 100% into equities, Now within equity mutual funds, you have all kinds of mutual funds. Broadly, you can buy a large cap fund if you're a conservative investor. You can buy into a mid cap, small cap fund if you're an aggressive investor. You can buy into a flexi cap fund for any kind of investor, because then the fund manager decides how much of large cap, mid cap and small cap. You have variety of thematic funds under the equities. You can play a manufacturing cycle, you can play an infrastructure cycle, you can play a banking cycle. So there are many options now available depending on for the layman investor. I think a multi-cap fund or a flexi cap or a large cap, they are really good products for layman investors. And for sophisticated investors, there are sophisticated products like a small cap or let's say a quant fund, those kind of opportunities. The other asset class is fixed income. Now again, for those investors who are trying to preserve their wealth or their liquidities for a shorter period of time, can participate into different kinds of debt funds depending on what is their investment horizon. So somebody who wants to keep liquidity for short-term needs can come into a liquid fund or ultra short-term fund, and someone who's looking at a 3 to 5 year and more kind of investment horizon, but in fixed income, do not want to risk their money on in equities, they can come into long duration funds, income funds, etc. So there are a bunch of products opportunities available on the fixed income side. And third category of funds which are very popular are the hybrid funds, which are combination of equity and debt. This also is a growing asset class. It's a pretty large, fast growing opportunity, which a lot of investors, typically when there are uncertainties or when valuations in the markets are very high, tend to come into, let's say, a balance advantage fund or a hybrid equity hybrid fund, and minimize the risk and try and make more returns than a pure fixed income fund. So three varieties: one is pure equities, pure fixed income, and a combination of both.
Let's dive into strategies. What are some effective investment strategies for mutual funds?
So I covered this in my previous question, but I think for really the core investment strategy in a mutual fund should be a flexi cap fund, right? Because this flexi cap fund by design gives freedom to the fund manager to decide which market cap bucket the opportunity is there, where valuations are looking attractive. So for example, there could be years when large caps look far better valued than mids and smalls, so the fund manager can actually increase exposure to large cap. Simultaneously, also at times when mid caps and small caps look good, the exposure to mid and small can. So investor can simply just put into the fund, let the fund manager do the job of deciding how much of large, mid and small, because this is the most frequently asked question, that how much in large, how much in mid, how much in small. So this should be the core allocation for any mutual fund investor. And then for those investors who are looking at some differentiated strategies, for example, for the next 5 years or next 10 years, Indian economy is likely to do very well. So within Indian equity, India as an asset class, let's say manufacturing looks as a core strategy. So one can get into a small allocation into a manufacturing theme or a digital theme or an infrastructure theme, right? So these are products for slightly evolved investors who understand risk, who understand these themes, who understand how to play these cycles. So I would suggest core allocation, satellite allocation. Core allocation should be more flexi kind of products, flexi cap, multi cap, those kind of products. And for slightly evolved investors can also get into certain high growth themes to benefit from those opportunities.
That's insightful. How should investors choose the right mutual fund based on their financial goals and risk tolerance?
So this is a very, very important question. You have hundreds and hundreds of mutual funds. We have 43 asset management companies. Fortunately, today there are a lot of platforms which are giving a lot of research on all kinds of funds. They are giving their own ratings, risk profiling. All of those things are being done by many online platforms, easily accessible to anybody. For the DIY investors who are trying to do it on their own, please go through these platforms, do your own research properly, and then you decide which product you would like to really invest into. Alternatively, I would always suggest that you should reach out to mutual fund distributors. They have the expertise, they have the capability to understand, to help you do your asset allocation, and then once that is done, help you choose the right products under each asset class, whether it is equity, whether it is debt, or whether it is commodities. So if you're doing on your own, do your research. There are many platforms, websites who are giving this service free of cost, but I would still recommend that mutual fund distributors can do that difficult job for you very easily and help you in your wealth creation journey.
Could you share any real-life success stories of individuals who achieved financial freedom through mutual funds?
So I speak to investors all the time. I have met a lot of investors who have had great experiences in mutual funds. So I've met investors who are let's say 20 years back in their mid-40s. Today they have retired and they started to invest their money into mutual funds through SIPs. And today they are having a very happy retired life, enough of financial freedom to do what they want to do. I have met investors who have planned for buying a car and they've done investment for 3 years in mutual funds, and it helped them achieve their goal to buy a car. Similarly, I have met investors who have actually sent their kids abroad to study thanks to the mutual funds which they have done in a disciplined way. So there are many happy experiences, especially with those investors who have actually spent 10, 15, 20 years in a very disciplined way, stayed invested through all ups and downs, all the cycles. But broadly, if you see, let's say a pure equity fund flexi cap kind of style has compounded at 15%, average of all the mutual fund returns over the last 10-15 years. Now 15% compounded means literally your money, your 100 rupees has grown by 4 times, 100 has become 400, right? So that's the beauty of this vehicle, mutual fund vehicle, and only thing you need is patience, right? Returns will follow, but patience is extremely important.
That's inspiring. What lessons can we draw from such stories?
Lessons is very clear that be patient. Money and wealth creation is it's a process. It happens with time. So one needs to have enough time in mind, to achieve their goals. So there will be times when there will be some crisis in the world. There will be some crisis in how we've lived through COVID. We are living through 3 wars which are going on around us. So there are going to be a lot of challenges from time to time when markets will kind of be flat or markets may correct by 20-30%. At that point of time, you need to have the courage and the patience to hold on, live through those crises. In fact, add more money when markets are down into the same products. And once you cross these 1 or 2 cycles of ups and downs, you'll have enough cushion in your portfolio available, which will help you ensure that eventually over long term you have achieved all your goals. So I would say that the courage to live through bad times, through volatility, through big corrections, big drawdowns, if you will live through that phase, nothing can stop you from achieving your desired goals.
That's fantastic advice.
Financial freedom and financial success is not just about the numbers. It's about the developing the right mindset and continuous learning. I'm sure many listeners will find inspiration in this approach.
Thank you once again, Akhil, for joining us. This conversation has been incredibly enlightening to our listeners. Thank you for tuning in. Stay connected for more inspiring and informative episodes. Don't miss our next episode, Leadership in Finance, Mr. Akhil Chaturvedi's personal journey, where we delve into his experiences and the lessons he learned along the way. Until next time, keep investing and stay financially savvy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.